Excuse me. All right, looks like we're live. So hello and welcome everyone. Thank you so much for coming out to Startup Boston Week. My name is Reeth, and I'm one of the organizers for the week. So what you'll see on your screen right now is the current sessions that are happening. So if this is not the session that you wanted to go to or is, then basically you can go up to the agenda right up top, and that will through there you'll be able to hop into the other sessions. And while while we're waiting for people to navigate around, we also absolutely love questions. So on your right, you will see a Q&A tab. There you can actually drop some questions for our panelists. And basically they will be able to answer that in a Q&A, maybe live or sort of at the end once all the questions kind of roll in. So we also want to point out that we have an awesome social media competition floating around. So basically what you're going to want to pay attention to is what the speakers are saying. And what we want you to do is on social media, grab one of those quotes and post it with the hashtag SBW2021. With that hashtag, basically, we are going to pick 5 people and 5 of them are going to win $100 gift cards to a Black-owned Boston business. So yeah, definitely grab a quote on social media, post it, and with the hashtag SBW2021. And lastly, I want to say a quick thank you to our awesome sponsor, McCarter in English. So definitely check them out. There is a doc tab on the right, and you can see them to the right. You'll be able to see a link to them on the right of the screen. And then also they have a booth in the partner section above. So be sure to check that out if you're interested at all. So I'm going to be passing it over to Benjamin and Christopher, and they will be taking it from here. So let me...
Thank you very much. Appreciate it.
Yep.
Okay, I'm getting a little echo, but hopefully that's just me. So hello, everybody out there. My name is Ben Hron, and I am a partner in the Boston office of McCarter in English. I'm also a member of McCarter's Venture Capital and Emerging Growth Companies practice, which brings together more than 30 attorneys from a range of different legal disciplines to advise entrepreneurs on nearly every aspect of their business. Collectively, we've helped guide thousands of companies from formation to financing to exit. And in 2021 alone, we've already helped our clients raise more than $6 billion. Our focus on representing startups and emerging growth companies is really what originally brought us together with Startup Boston Week. And the outstanding quality of the programs and the presenters is one of the reasons we're so excited to be here again, not just as presenters, but also, as Reed said, as sponsors. So we're really excited. I'm here today with Chris George from SeedInvest to talk about raising capital under a law known as Regulation A, sometimes called Reg A. We're going to start with a little background to orient those of you who aren't familiar with Reg A. And then we're going to talk about why Regulation A might be a good option for raising capital for your business, the requirements for raising capital through Regulation A, and the process of raising capital through Regulation A. And we also expect to have some time at the end for your questions. So Chris, do you want to say a few words about yourself and SeedInvest before we dive into the content?
Yeah, absolutely. And thanks, Ben, for that intro, and thanks for, I guess, originally inviting me to this, and thanks to Startup Boston for hosting what looks like a pretty great week and pretty good turnout. And last, we appreciate all those tuning in. So yeah, as you mentioned, I work at SeedInvest. I'm a senior member of what we call internally our venture team. Primarily, our responsibilities are talking with companies, finding companies that we want to put on our platform, and ultimately evaluating those companies for investment purposes. And we can kind of run in a little bit, I think, to the history of Regulation A+, and I can get a little bit more into the history of SeedInvest. And I do think we meant to be this, sort of as an interactive session. So if there are already, questions, I think there's a Q&A on the right side of my screen at least. So, audience, feel free to just chime in when and if needed.
All right, thank you, Chris. And actually, one of the things I wanted to mention on the same vein before I talk a little bit about the origins of Reg A, if there's anyone out there in the audience who's interested in using Reg A to raise capital, I invite you to think about what's your pitch to potential investors. That quick catchphrase like we bring good things to life or better living through chemistry. That will convince a potential investor browsing through SeedInvest to stop and look at your offering. Because ultimately, like any other financing, you're competing with other companies that are raising capital. And if you're feeling particularly bold, please share your catchphrase in the session comments. And maybe we'll get a chance later on to talk a little bit about which ones might make good ideas for a Regulation A offering. So with that, let me dive a little bit into the history. Most companies that raise capital, companies raise capital by selling to investors an ownership interest in their business, in the company itself, or something that's intended to become an ownership interest in the company. So you'll oftentimes hear companies selling preferred stock. You'll also hear about them raising money through convertible debt or what's called a safe instrument. In legal jargon, all of these things are called securities. And in the United States, the sale of securities has been regulated by the Securities and Exchange Commission since 1933. The Securities and Exchange Commission, otherwise known as the SEC, sets the rules that govern how securities are bought and sold. And the first and most basic rule that every sale of securities has to comply with is a sale of securities has to be either registered with the SEC or exempt from registration. So that's your basic framework. Now, I expect many of you have already heard of a law called Regulation D, or at least a section of Regulation D that's called Rule 506. And Rule 506 contains the legal framework for an exemption from the SEC's registration requirements that is the basis for most capital raising transactions in the United States. Regulation A, as the name suggests, is actually a little older than Regulation D. And Regulation A actually offers companies, it's another exemption from registration, and it offers companies one big advantage over Regulation D, which is the ability to sell securities to anybody, regardless of wealth or income. One of the big things about Regulation D is you are limited for the most part to raising money from what's called accredited investors, basically people that meet certain income or net worth thresholds. In Regulation A, you have the ability to raise money from people that don't meet those thresholds. Nevertheless, Regulation A has languished in obscurity for most of its existence because until recently, it only permitted companies to raise up to $5 million, which wasn't enough money for companies to justify the cost of complying with the law. That changed in 2012 when the Jobs Act became law. And you might have heard about the Jobs Act. It covered a whole range of different topics relevant to raising capital, including crowdfunding and including various changes to Regulation D. But one of the things it did was it directed the SEC to revamp Regulation A, including increasing the offering limit from $5 million to $50 million. Those changes took effect in June of 2015, and since then we've seen a resurgence of interest in raising capital through Regulation A. That offering limit was raised again from $50 million to $75 million in March of this year, which just makes Regulation A even more compelling as an option for raising capital. So I'm going to turn it over now to Chris to talk a little bit about the business case for using Regulation A.
Yeah, And Ben, thanks for the background there. So yeah, SeedInvest kind of traces its history back to the genesis of online capital formation. And we have the ability to raise, as you mentioned, from both the kind of accredited and institutional network of investors, but also from this non-accredited or, in kind of vernacular, more retail-oriented investors. Since that time, since the Jobs Act has come out, we've deployed over $500 million across, call it roughly 200-ish startups. But that doesn't mean that each company, looks for exactly, call it 2.5 million. We would work with a company anywhere from, call it 500,000. And then, in this new Regulation A+ world, the deals are getting a lot larger. So for example, we have a company on our platform right now, which is raising $50 million, which would be certainly the largest for SeedInvest in its history, but also I think, pretty much up there in the upper stratosphere of online capital raises to date. We as a company really decided to focus on Regulation A+ about, call it 2 years ago, and we've raised well over 200 million under this specific exemption so far. It is kind of what we consider our premier offering. When we take on a Regulation A+, we have what we kind of call 100% success rate, meaning, we've raised at least the minimum that a company is looking to raise under this offering exemption. In 2020, which was last year, we did over 75 million in this Regulation A+ format. This year, we're looking to more than eclipse that. We're probably on pace to deploy over $100 million in Regulation A+ securities this year. And, as you mentioned, Ben, the offering type itself has grown in popularity. I think a little bit of history, and I just sort of grabbed some of these statistics off the internet, so who knows exactly how accurate they are. But 2020, there was 1.5 billion placed under Regulation A+. This year, it's on pace to cross 2 billion, which is a nice, healthy growth. And a lot of that, as you mentioned, is coming from just the increased offering size, renewed interest. And, we can't forget this kind of move to remote work, right, which COVID sort of prompted. And I think for our industry, at least, in my opinion, it's really advanced what we do in terms of online capital raises by a decade. We're seeing higher quality companies, more investors. It's been a really interesting transformation that we've seen over the last, 18 months. So, when you talk about business case, generally speaking, these are going to be growth stage companies, that definitely have a product out there. And there's exceptions to every rule, right? So, for example, a biotech company is never going to have a product until, they are bought out, for example. So there's exceptions to every rule. But generally speaking, these are companies that are looking for growth capital. They have a product or they have a service that's already in the market. They have traction, they have customers, and now they're just looking for capital to either expand their sales force or marketing or investment into their company, meaning, property, equipment, etc. But generally speaking, these are, post-revenue companies, post customers that have a full-time team in place, usually, more than just the founder or the co-founder, and they're really looking for that next stage of capital. And I can kind of get into the benefits of public offering, but let me kind of stop there for a minute.
Yeah, I mean, by the way, just for people's information, Regulation A+ is sort of the industry name for the updated Regulation A. There's no separate rule Regulation A and Regulation A+, but just because it's better than the old Regulation A. So I mean, Chris, I was going to talk a little bit about the tiers of Regulation A. There's Regulation A is split now into two different tiers, Tier 1 and Tier 2, and there are a couple of pretty critical differences between the two of them. Tier 1 allows companies to raise up to $20 million in 12 months. There's no limits on investor qualification or amounts that are invested, and you're only required to provide GAAP financials, financials that comply with generally accepted accounting principles, which makes it a little bit easier. Tier 2 has some more stringent requirements. You can raise up to $75 million, but there's some limitations on what investors can invest. They either are limited to 10% of their income or net worth unless they're accredited investors. You have to provide audited financials, not just regular GAAP financials. But there are some upsides. In return for that, you don't have to deal with state securities laws. And I think that one thing that a lot of people struggle with is, well, if I'm raising less than $20 million, do I go with tier 1 or tier 2? Chris, any thoughts on that decision?
Yeah, no, it's a great question. And, funny enough, SeedInvest, we actually don't do tier 1 offerings at all. And it's exactly for the reason you pointed out. The state-by-state filing requirements are very onerous, very time-consuming, very expensive. And so even if a company is really just looking for $5 million, we opt into the tier 2. We find that the audit for most companies is not an extreme blocker, and to remove the state-by-state, and this is kind of your world than my world, but to remove the state-by-state blue sky filings is well worth it to go out there and get historical financials audited.
Yeah, that's been our experience too, and I think that from a sales standpoint, having audited financials creates a little bit more legitimacy, which is well worth it. Relative to, you get the benefit of not having to do the state filings, which really are a pain, and at the flip side, you get the added sort of legitimacy of having audited financials. So I think we agree, and that's I think that's where we see most companies deciding to go. There are a couple of other legal requirements involved with raising capital, and the big one is you actually have to file a document with the SEC, and it has to be reviewed by the SEC and qualified, and that's a process, right? So the offering document is something called a Form 1A, and it contains a whole bunch of things, but it requires you to provide the financial information. It requires you to provide a description of your business, to talk about your officers and your directors, talk about your business plan, the risks involved investing in your business, and it requires you to file with the SEC lots of different documents, in particular material contracts, lots of other things that basically provide people with some guidance as to what your company is all about. And it's, in that sense, it really is sort of like a little mini public offering, right? It's not quite a full-blown public offering and a full-blown SEC review, but the SEC does look at these documents. They will comment on them. They will come back to you and say, we need you to clarify this, or we need you to provide information about that. And that's, that takes a while. Compiling all that information can take a couple of months to do. And so you really have to sort of have that timeline in mind when you're thinking about what it's going to take to raise money through Regulation A. So there are a couple other limitations. Right now, Reg A is only available to, I believe it's US and Canadian companies. Chris, I think that's right.
That's right.
And you can't be what's called a blank check company. You can't be a SPAC. You can't be an SEC reporting company. So it's really for privately held US and Canadian companies that have an active business that they can talk about, as Chris was saying a minute ago. You are, however, permitted to do some things that sort of ease the way a little bit. And among those, you're permitted to confidentially file with the SEC. In other words, you don't have to go public with your filing with the SEC until at least 21 days before you're ready to go out. So if you're a little nervous that maybe you're not sure if you want to do it and you don't want to risk having to be sort of out there as publicly filing and then withdrawing the filing, you have the option of filing confidentially. And you also permitted to do something that's called test the waters. And Chris, maybe you can talk a little bit more about that process and why that's important.
Yeah, no, it's a great feature. And so companies that want to go out there and gauge investment interest prior to actually going live with the capital raise are able to test the waters, right? And it's really great for, in particular, what we do. So if you just kind of, switch gears for a moment and think about from an investor standpoint, an investor comes to SeedInvest and looks at, company XYZ that's raising, I'm making numbers up here, but 10 million in Regulation A plus. In order to become an investor, you have to register with SeedInvest. And these are also, these registration processes are also subject to SEC rules and regulation and FINRA. And so, for example, we have to do things like KYC, know your customer, or AML, anti-money laundering policies. So a little bit of, call it, high-level background check on our investors. But when it comes to testing the waters, these investors have to fill out something like 4 out of 5 steps, right, in the process of actually wiring funds. They stop short of actually wiring funds to the company. But from a company standpoint, if you kind of shift gears back from the company perspective, it's very sticky reservations. We call them reservations, right? This testing the water, these gauge of interest, they've literally already filled out the brunt of the work. And now when a company does go live, then they can just literally wire the funds, which is great. I think the advantage of testing the waters obviously is, you can make sure that you got the pricing of the instruments correctly. You can make sure that there's actually investor demand. And, for most of what we do, we sort of hold, I would say, rolling closes. So in other words, if we're looking at this again, hypothetical 10 million raise, maybe we hold a first closing at 2 million. And if we cross that in testing the waters, for example, well, you can be pretty confident that on day one, we can actually close the 2 million and wire that to the company and then sort of hold rolling closes after that. So it can be very useful from a planning perspective and projections if a company is looking to, for example, hire a sales force or something like that. So it is a really neat feature, which is not available under, it might be actually under the new regulation CF, the revamped, but for all intents and purposes, this is a really good feature for a company to get out there, gauge investor interest, and decide really if they want to follow through with the offering.
Yeah, and I think you touched on something there that's probably worth mentioning, worth talking about a little bit more. And actually, before I get to that, I just want to encourage anybody has questions to put them in the Q&A section. We're happy to answer questions. I'm sure hopefully there's a lot of questions. So please type them into the Q&A session and we'll get to them shortly. But I think that distinction between sort of Reg CF and Reg A isn't one that we've talked about yet. Reg CF, which also sort of came about because of the Jobs Act back in 2012, allows you to raise capital through an online portal, and SeedInvest is registered CF portal, right?
That's right. Yeah.
Yeah. So, I mean, that there are a number of them out there, but it has to be on a dedicated portal, and you can raise, I believe it's right now up to 5 million. It was 1 million and change, and then the offering limit was increased to 5 million. And there's no SEC filing requirement. The disclosure requirements are a lot more limited. So it's a different type of offering, but sort of it similarly allows you to reach out to large numbers of the masses in order to raise capital. But I think, at least the way I think of it, Chris, and tell me if you think differently, it's really more geared towards very early stage companies, predominantly without operating histories. That's what I tend to see raising capital through Reg CF more than Reg A.
Yeah, I think generally speaking, that's correct. And certainly before the change, the increase from 1 million and change up to 5 million, that was definitely the case.
Yeah.
We're starting to see some really interesting, I would call them kind of later stage companies, and this will actually segue into the question that we have, but we're starting to see some later stage companies look at this and say, you know what, if I can raise 5 million without going through the Form 1A process and the months and months of back and forth with the SEC, well, maybe I take that as a first step. So, I would say your comment on generally these are earlier stage companies without operating history used to be certainly true, but now we're starting to see kind of those, it's kind of a funny word, but one of those tweener companies, right? That's saying, yeah, maybe we need 5 million, maybe we could do with 4. So therefore the regulation A plus, the whole economics of it, meaning the expense side, might not make perfect sense. And then they can now default to this essentially smaller capital raise, but still get, in my opinion, a pretty robust amount of capital. So let me get to a couple of questions that just came up. And I hope I'm saying this right, but Satish just asked, how is this different than Series A and beyond? And I think he's referring to the Regulation A plus as different than Series A and beyond. And I think this is a great question. And it's kind of funny because sometimes what we find ourselves doing, and Ben, you can certainly relate to this, but we sort of straddle a world of regulatory compliance and venture capital, right? And this question in my mind is a little bit of, we don't want to confuse the regulatory environment with venture capital. But when we talk about, stages of companies like a seed stage company or a Series A stage company or Series B, C, et cetera, generally speaking, this language was kind of invented just to get a very quick kind of back of the napkin math on what stage is a company in their life cycle, right? So Series A, and these are changing because there's so much capital in the marketplace, but generally speaking, Series A used to be any company that's raising from, call it anywhere from 2 million to 10 million. Series B would be the kind of next iteration, maybe 10 million to 20 or 30. We've seen these kind of loose criteria and these loose limits balloon in recent years, again, because there's so much capital in the marketplace. But really, when you talk about a Series A, B, and C, they are just kind of sequential measurements of where a company is in its life cycle in terms of their capital raising abilities and desires, but also just stage of company, right? There's some investment shops, like a venture capital fund might say, hey, we only focus on Series A or Series B stage companies. Generally speaking, that would mean this venture capital firm is probably writing checks anywhere from, 2-3 million on the low end, maybe 20, 30, 40 million on the absolute high end. So that is very different than what we're talking about here, which is the Regulation A plus. This, as Ben mentioned before, is an exemption to existing securities laws, which allows companies to raise capital from the public, meaning, anyone and everyone, but remain as a privately held company. Is that sort of fair? Does that sort of answer?
I mean, I think that, you can be, first of all, in both cases, you're a privately held company to start, right? And so you can raise, as a privately held company, you can raise money through Regulation A, you can raise money through Regulation D, which is what's used for Series A, typical venture capital financings, right? Series A, B, C, seed financing, stuff like that. In either case, you're raising capital by selling securities. Oftentimes you're selling the same type of securities. We do regulation. We've done Regulation A offerings selling a preferred stock, just like you would in a Series A round or a Series B round. The difference is really who you're selling to, right? In a Regulation D financing, a typical Series A, B, C financing, you're selling typically to usually institutional investors, but at the very least high net worth individuals, right? In a Regulation A offering, by contrast, you have basically a much larger universe of people who can invest. So you're not limited to that group, but the process is also very different. A typical venture capital financing, it's negotiated directly between the company and the investors. It's a small group of investors. Oftentimes, it's only one or maybe two investors that are leading the charge in terms of negotiating the terms, and everybody else sort of goes along for the ride. In a Regulation A financing, the company is putting out the terms to the world, and largely there isn't much in the way of negotiation. It's, you have to sort of, as the company, decide, largely in consultation with me, with Chris, what the appropriate terms would be, and then you go out and and try to sell it to the public. So I think it's just, they're just different ways of raising capital. There was another question Satish had, which was, can Regulation A be combined with other, I think others meaning other types of financings? And the answer is yes, but you have to be a little careful. Regulation A is a public offering. You are putting information out there about selling securities to the public. And that means you can't combine it with, simultaneously with a transaction that has to be purely private, like a traditional Rule 506 financing. Now, there's various ways in which you can make them work sequentially and whatnot, but you can combine it. You just have to be careful about the way you do it. So, for example, what we do see sometimes is companies say, okay, I don't necessarily have the capital, the spare capital to go out and raise, to do a Regulation A financing right now. But if I can raise a little money from angel investors or from a venture capitalist, I could use that money to piggyback or to fund my Regulation A financing. So we do see companies looking at that possibility sometimes.
Yeah, and I'll just add here that these methods of raising capital do not have to be mutually exclusive, right? So if you go out and really from a company standpoint, we're sort of talking about, if you think about a car, we're talking about like under the hood, right? Whereas a company may say, hey, we just need to raise $20 million and we don't really care if it's a, Regulation A or, C or D or B or whatever. It doesn't really matter. And I think, from a corporate governance standpoint, you don't want to be in a position where on one hand, you're raising, raising capital at $1 a share, and then you come to, a SeedInvest and file, with the federal government, a new round where you're raising capital at $2 a share. It just looks like it could get confusing. And again, I think for, the longevity of a company, just kind of organization, if nothing else, you sort of want to have unique and distinct rounds that sort of, start and stop and don't bleed into each other. But that said, certainly when we conduct capital raises, the companies that we work with, most, if not all of them, will have some participation from their own investors, whether they're existing investors or just, new investors that they meet along the capital raising process. So, these do not have to be mutually exclusive.
So, Chris, maybe we should talk a little bit about sort of the process itself and the timeline, because I think, it's one thing to talk about the laws and the business case, but to give people a sense of really, what does it look like if you decide to go forward with Regulation A? I mean, I think the first step is really calling you,
right,
and saying, hey, this looks interesting to me. What do I do?
Yeah, absolutely. And, at a very high level, I kind of break the process down into three big steps. So yeah, the first step is definitely, hey, let's have a conversation, decide if this is something, that would be in scope for the company and for SeedInvest. And then essentially we would kind of start on conducting due diligence. So SeedInvest is a little bit different, where we have an investment committee that basically has to approve each deal that we bring onto our platform. And, this consists of, looking at a company's historical operations in terms of financials, projections, a pitch deck, a cap table, all of the kind of usual suspects. And during the course of our investigation, there's multiple touch points with a company. And, we kind of take, I would say, about 1 to 2 weeks to evaluate whether it's a good fit. And, we are happy to kind of suggest a valuation, or a lot of companies, again, kind of come to us with a valuation in mind that's derived either from, their internal studies, or again, maybe they have an anchor investor and they're just looking for subsequent capital. But nevertheless, step one, call it this investment committee process, 1 to 2 weeks. If there is a positive result in the investment committee, then that kind of moves into the second step of the process, which kind of gets into what the bulk of the conversation has been today. It's all about deal structuring and onboarding and filing. So during this process, we would connect a company with someone like Ben, and they would start on this Form 1A drafting. And Ben, I'll let you kind of, talk about that a little bit. But the other steps from our standpoint are to start this 2-year historical audit that's required as part of the Form 1A package. And then, of course, we're working on the investment documentation. So in other words, what do investors actually sign up for when they wire a company funds? And then I'd say the last kind of item in the second step here is, it's kind of the infrastructure of the round, meaning, we'll build an investor-facing profile. We'll collect information like, what bank account do we wire these funds to when we actually raise the hypothetical amount? So again, it's a little bit of sort of deal structuring and onboarding, and some of the items that we've kind of talked about today. In terms of timing, there's a huge variance here, right? Some companies, maybe they started their company 2 months ago, and therefore they don't really have 2 years of historical operations, and they wouldn't really need an audit. The audit would come back as a blank piece of paper. Some companies have 15 subsidiaries with inventory all around the world, and that's going to take a long time for an audit, and of course for the drafting of the Form 1A. So, best guess here, you're looking at kind of 6, 8, 10, 12 weeks. Maybe a little longer, just depending on the SEC and their responsiveness. And then, the sort of last step in the process, third and final, is when we're actually out there raising the capital. And this is definitely the marketing element. This is when we've sort of trued up all of those reservations under the testing the waters. But from our side, there's sort of 2, I would say, strategies in the marketing. And, one strategy deals with these larger check writers in our network. So, for context, this is going to be maybe $100,000 check writer or more. And generally speaking, that's a little bit more hand-holding, a little bit more white glove. They want to meet the management of a company. They may have diligence of their own. They may have an investment committee of their own, right? So a little bit more involved on that side. And then, the second strategy in raising capital is much more digital, kind of using the scale and power of the internet. But, it's emails, it's newsletters. We host webinars just like this. We can do, online demos of a product or a service. In the background, we do, search engine optimization, Google AdWords. We put UTM codes and pixels on all the collateral we're sending out. So we're actively tracking it in an analytics dashboard. We can do third-party conferences, conventions, podcasts. We can do, for example, and we have ads in the Wall Street Journal. We can get companies on CNBC, right? So that's, again, one of the benefits of this type of offering is it can be a great brand building exercise. There's sort of sky's the limit on how we can get the word out. But in terms of timing for this, last step of the process, the third and final, as I mentioned, we would hold sort of a first closing, and it does not have to be the total the company's looking for. It might be a smaller amount, but we would hit that first closing number, hold a closing, wire the funds, to the company, and then sort of hold rolling 2-week closes after that. So, when all is said and done, I would say time to cash from when we sort of have our initial first discussion, best case scenario, you're looking at sort of 90 to 120 days. Worst case scenario, something more than that. And Ben, I don't know if you had similar experience or in terms of time.
I think that timeline's right. I mean, it takes just, first of all, if you don't have audited financials already, which a lot of companies don't, that audit takes a while, especially since you have to go back 2 years. So, that is a gating item for a lot of companies as they're going through this. The legal documentation, the offering circular or the Form 1A that I talked about earlier is involved, but it's probably not the most involved piece of this. We need the information from the audit, so that has to happen first. But other than that, there's a lot of pieces of the Form 1A that are standardized isn't the right word, but they're things that are common to a lot of offerings to the public. And so, we have a framework for an offering document that helps us guide you to what you need to provide, the information you need to provide, the descriptions and stuff like that. But it still takes a while to get together because you have to coordinate a variety of different pieces of your business to get all that information together. It has to be written up in a way that's presentable, both to the SEC and ideally as a marketing document to the public. And then you do have to file it with the SEC. And the SEC, sometimes they're kind and they'll go through it real fast, but you have to expect that it's going to take at least 3 weeks to get your initial set of comments, and it can drag on for a couple of months. So it is unfortunately just the process. But what we found is that we can help companies push it through pretty effectively and get that timeline down to the 120 to 150 days, 4 or 5 month mark most of the time, which frankly doesn't, if you think about it, if you're doing a traditional venture capital financing, from the time you actually start actively going out and soliciting investors to the time you close your round, I think the time is pretty comparable. So it's not really any different in that respect.
Yeah, I'd agree with that. And, I think one of the other maybe kind of benefits of this versus going the traditional venture capital route, you may be, as a company, maybe working with a venture capital fund for 6 months, just going through diligence, meeting partners, et cetera. And then at the last minute, they may say, hey, this just isn't a fit, thanks. And then you're sort of starting the process over. Whereas this, process, nothing's guaranteed, of course, right? But this process is really meant to go out there and, systematically raise capital. So I'd say there's a little less kind of guesswork involved, I'd say. We do have another question. We sort of have a monopoly on the questions here, which is fine. But maybe I'll just publish this one because I think it's a good one. And a lot of companies ask this. So there's kind of a couple of different things going on here. So how does this impact the cap table? And that's a great question, right? Because ultimately, once you complete a Regulation A+, you'll have, I don't know, anywhere from 500 to 1,500 or so investors. And of course, you don't want all of those on your cap table. It would be very messy, very difficult to manage. So from SeedInvest standpoint, what we do is we actually group all of our smaller investors into one line item on your cap table. And again, for context, generally this is $100,000 check writer or lower would be grouped into this one line item, right? Those investors who kind of 100K or more, usually they sit directly on a company's cap table just because usually they have a relationship that they build. Again, these are the investors that they've met kind of one-to-one and maybe gone through their investment committee. Generally speaking, these investors might invest in future rounds. So we just kind of encourage companies to build a relationship with those larger check writers. But everyone else, grouped into one line item on a company's cap table. SeedInvest is happy to manage those investors on behalf of the company going forward if they want us to. So for example, you get, one email address at SeedInvest. And if you wanted to release, say, your annual financials to your investors, you could just email it to seedinvest.com and we would then disseminate to your investors. So it's meant to be set up where it's very, very user friendly, very easy. The best example I can give of this, because a lot of companies will kind of say, well, does this impact any future capital raises? Does this impact anything going on, if I want to raise subsequent capital, or if I want an exit, or if I want, this or that. And I can say it does not. We literally just announced we had a great company in our portfolio called Heliogen, and they announced that they're going public in a SPAC transaction valued at $2.5 billion. And we were able to turn around those investment documents back to the company within 2 weeks. So we didn't hinder their ability to go public whatsoever. And it's going to be a great return for our investors. The second part of the question, which is kind of what do these investors get and the dilution? Yeah, so the dilution part, that's really hammered out in our investment committee, if you recall that kind of first step of the process. And usually, I'd say 99% of the companies that we work with in the Regulation A+ capital raise, as I mentioned, are later stage. So generally, they're raising preferred equity, right? And, so for example, if a company raises $5 million at a 10 million pre-money valuation, and they raise the full 10 million, then their post-money would be 15 million, right? So these investors would get 33% of the company, 5 over 15, right? And that is exactly what we consider as dilution. Future rounds, when hopefully the value of the company goes up, the company raises more capital, these older investors kind of get diluted down. And that's what we sort of mean by that. But yeah, I hope that sort of helps answer the question.
Yeah, and I think, Chris, I mean, it is important for people to understand that usually there is, there are voting rights that come with these shares. There's all sorts of, they're stockholders.
Right.
But there are ways in which we help you structure the transaction to make sure that doesn't interfere with the business. So going back to the question earlier about the differences between this and a Series A round, you don't typically see investors in a Reg A financing getting the full suite of rights that a traditional venture capital would get. They're still going to get some protective provisions to make sure you can't, change the deal on them, change their rights and preferences. But usually what we do is we limit some of the rights to the major investors. Those people Chris was talking about earlier that invest $100,000 or more. We include voting provisions that make sure the company isn't simply stuck if they can't reach some of the people who are supposed to vote. So there are ways in which we structure the deal from a legal standpoint to make sure that this doesn't impact your ability to operate going forward. So it's a good question, and it is something that goes to, but there's some challenges that are involved in a Reg A financing, both upfront in terms of the time and the cost involved, and then going forward in terms of just having more people on your cap table. So doing a Reg A financing is something that you have to think about and do with your eyes wide open. But for the right kind of company, it really is a game changer. And for the right kind of company, it a lot of times it'll make more sense than a traditional venture capital raise.
Yeah, exactly. And I think the really important distinction here is, the company, and Ben, you kind of mentioned this in the beginning of the conference, but companies are selling securities, right? And ultimately, that's what investors get. The form of these securities, how they're structured, that is sort of a longer conversation. But ultimately, the investors are essentially buying a right to ownership in the company. So yeah, that's sort of in a nutshell what are these investors getting? So, I think it is worthwhile because we talked about, the process. It does sound, slightly onerous. It is involved. You do want to go into it with your eyes wide open, but what are the benefits of doing this, right? Why would a company want to do this, right? And I've just sort of typed up some notes, and Ben, I'd love to hear your thoughts too. But I think there are a lot of benefits of doing Regulation A plus. First and foremost, it's really the only way that smaller private companies can raise capital from the public, right, and remain privately held. And that's very interesting. You can diversify your shareholder base, of course. We already talked a little bit about test the waters, which is great. It's really hard to test the waters with, venture capital or family offices. Of course, they're always going to say, yes, I'm interested, just to see, a deck or peek beneath the hood, so to speak. There is, and I'd love, Ben, if you could expand on this a little bit, but there is a path where if a company conducts a Regulation A plus, it actually makes the process for an IPO much easier and shorter. And I, of course, don't know all the legal implications of that, but from what I do understand, the original structure of Regulation A plus was sort of in this preparation for an IPO. If a company wanted to, these are all options. This is not required. Isn't that right, Ben?
Yeah. There is a process for making the shares freely tradable, and I don't think it makes sense to go into it too much in the time we have, but basically it involves some ongoing reporting obligations on the part of the company so that there is information out there for the public, and then registering the securities for resale, which is a much simpler process once you've actually already gone through the Reg A process. So, and that is something that some companies take advantage of, and particularly if you're a later stage company that maybe is looking for a little liquidity. I think there's a default in my universe, at least because of the startup companies I tend to deal with, that everybody's looking for venture capital, then sell for $1 billion or go public. And there's a lot of businesses out there, very successful businesses out there, that maybe they raise a little money from friends and family, but they don't have institutional investors. There's not this pressure to sell. Maybe the founders don't want to sell. They don't want to necessarily go through a full-blown public offering, but they've got some people that would like a little liquidity, and it is an opportunity to get some liquidity for your investors, for yourself. So I think that's that is a significant plus to Regulation A.
Yeah, I love that. I think it's great, and specifically, what we can do under this offering, under the Regulation A plus, is 30% of what a company raises could be secondary sales. So, for example, if a company raised $10 million, $3 million of that could be, for example, the founder selling his or her stock, right, at that round valuation. So I think it's wonderful. I don't think enough companies take advantage of it. Ben, you make the phenomenal point that in venture capital, oftentimes it's, a gigantic, improbable, huge exit, which, results in a, Mark Zuckerberg type, wealth generation, or it's nothing, right? There's kind of like nothing in between. And this structure of Regulation A plus does sort of offer that intermittent liquidity, which I think is, great. And I personally wish more companies would take advantage of it. But, so those are some of the benefits, a couple other real quick benefits, as we sort of have been talking about, and as you can kind of tell, our investors are generally speaking very passive. Companies aren't giving away the keys to the kingdom, so to speak, which is very attractive. Certainly when a company becomes a little bit later, when they're raising 50, 75 million, generally speaking, they're not looking to fill their board up anymore. They're not looking for strategic advice anymore. They usually have hired the right people in the right places. And now they just really need, that kind of fuel to add to the fire, so to speak. Another, kind of obvious, and we've sort of talked about it a little bit, but it's, building your brand. The CEO of my company says getting the word out about a startup is one of the hardest parts. And this is a great tool to do that. You can raise capital from your customers, for example, if you have, a consumer product. We can do, as I mentioned, an ad in the Wall Street Journal if you wanted to. We can put a company on television. We can put them in podcasts. It's a really great way to build your brand and build awareness and really get the word out. I'd say last but not least, obviously, you gain new users, you gain, new customers, you gain new investors. So it's a really interesting tool. And I think there are a lot of benefits to it, but at the same time, it does need to be conducted with conviction, right? Because there's a lot that goes into it. That timeline itself is lengthy, and there are some upfront costs to it, right? So there's the filing fees, there's the audit, there's the legal, and I don't know if we want to spend a little bit of time on that topic, but
I think it's probably worth saying that ballpark, you're probably looking at least $150,000 to $200,000, maybe $250,000 of costs before you're actually able to take in money. Because there's audit fees and there's legal fees and there's all the other, and there's frankly just the time for your business, the time, the opportunity cost. So, that is something that companies need to understand. And that's one of the reasons why some companies look at, well, can I raise a little money, from private investors before going to a Reg A. But as Chris said, there's just a lot of advantages for a company that's in the right place. And I want to just hit this last question here before we run out of time completely, which is a Reg A good idea for someone who doesn't want to go to a Series A, go sort of that route? I think they're different. There's sort of different ideas. You can absolutely do a Reg A financing if you have no interest in ever raising venture capital or going that route. And at the same time, we have companies that have raised venture capital and then do Reg A financings. It's not so much about the path you want to take. Either of them works. It's really more about your business and the trade-offs, the upfront cost versus the money you can raise, the exposure versus having to deal with people on your cap table, the time it takes. So it's not for everybody, but I don't think it's specific to what you see as, are you a venture capital backed company or not? It's really, is this the kind of thing that will be good for your business overall?
Yeah, and I'll add that I'm not sure if we did cover this in sort of the background on it, but this limit of $75 million for a capital raise, it's really in a rolling 12-month period. So, companies that come to us and maybe say, hey, I'm not large enough to raise 5 million today or, whatnot, we can do a smaller round. And then maybe they come to us and say, great, now we can support a $5 million capital raise from a dilution standpoint. They may come back in 12 months and say, look how much we've grown. We hit our projections, we hit our milestones, we put the capital to good use. And now we want to raise 25 million, right? At a much larger valuation to manage dilution. So yes, absolutely. If a company wants to raise this and that's it, no problem, that's fine. If a company wants to raise this and then venture capital, no problem, that's fine. If a company wants to raise this alongside venture capital and then future rounds like this alongside venture capital, absolutely no problem. It's really, from a company standpoint, it's just another tool in the toolbox to get capital, to get a significant size of private investment.
All right. Well, if there are no other questions, I think we'll wrap up about 1 minute and 24 seconds early.
Sweet. Well, thanks, guys. I'm sure everyone really appreciated hearing about the alternative finance routes that they have available to them. But yeah, so we have some great content coming up after this panel as well and for the rest of the week. So be sure to tune in and check out the agenda. Thank you, guys.
Bye, everybody. Thank you.
Thank you.
Thank you.